The painful reality is this: most people who start trading Forex lose money, not because Forex trading is a scam. They fail because they start trading before they learn how to trade. That is starting without the right knowledge. Many beginners jump into Forex trading hoping to make quick money. They open accounts, deposit some money, and start placing few trades. Few days or weeks down the line, the account is gone. The good news is that it doesn't have to be that way. If you understand the basics before risking your money, you will avoid costly mistakes that wipes out beginners' account. Hello traders, welcome back to my YouTube channel. In this video, I will show you exactly how to start trading Forex the right way, step by step, and equip you with the essential knowledge you need to confidently begin your trading journey. Whether you are a beginner or you already know a little about Forex trading, this video will simplify the concepts, clear up common misconceptions, and give you a solid foundation to become a more confident and disciplined trader. If you are ready to learn how Forex trading really works, let's get started. Here is what we are going to cover in this video: what Forex trading is, how the Forex market works, what a Forex broker is, understanding currency pairs, and how to make money with it. Forex trading sessions, time frames, lot size, pips, and how they are calculated. Take profit and stop loss and how you can place them. And the last one, how to place your first trade. If you really want to get started with the right knowledge, you need to watch this video till the end. And do not hesitate to drop your question in the comment. I will reply each and every question. I will respond to them. What is Forex? Forex simply means foreign exchange. It is the global market where one currency is exchanged for another. So, Forex trading is the buying and the selling of different countries' currencies to make profit from the changes in the exchange rate. That's where the profit comes from. It is the world's largest financial market with over $7.5 trillion traded every single day. Forex trading is the most liquid financial market in the world. Let me give you an example. If you want to travel from Nigeria to US, you need the US currency, United States of America's currency, that is dollar. You now use your naira to buy dollar. You have participated in Forex trading. Again, if you are the type that speculates that price of a particular currency, let's say dollar will go down or euro will go down, and at the long run it will appreciate or it will rise, and you decide to use your money, go and buy dollar and keep, or you buy euro, for instance, and keep. Then when the price of dollar appreciates or goes up, you decide to go and sell it to make profit. You have also participated in Forex trading. Now, this is exactly what we do in Forex trading. But then the difference between someone that goes to the black market to buy or over the counter in the bank to buy and the one that is trading it with laptop computer is that the ones that are trading it with laptop and computer is doing it electronically through a middleman called a broker. And when you do this electronically through a middleman called a broker, you make your profit from the exchange rate difference, or you also make loss from the exchange rate difference. You do your own electronically, then another does his or her own physically. That's what Forex is, and that's what we do here. What exactly do we do in Forex trading? We predict or we speculate. Any of the two words is okay. So what we do is we predict that price will go up and we place a buy. If price goes in our direction or in our favor, we make money. And if equally we predict that price will go down and price go down in our favor, we also make money. In the other hand, if we predict that price will go up and price go against our prediction or our speculation, like price falls down, we lose. That is how Forex work, or that is what Forex is all about. It's important you understand this concept because that is what will help you in your trading journey. Let me give you a practical illustration. Let's say you predict that euro will go up. Euro will go up. And euro actually go up. You will make profit because what it means is that when you do this prediction, you will place a buy. Then you also predicted that euro will fall and you went ahead to place a sell. That means if euro fall, you will make profit. On the contrary, if you predict that euro will go up, that euro will rise, and you place a buy, and euro actually fall, that period that you place a buy, you will lose money. Same way, if you predict that euro will fall, that price will depreciate, price of euro will depreciate, and you place a sell and euro goes up, you will equally lose money. It's a two-way thing. So it's a business of probability. It's a game of probability. So you predict it is going to be this way. If it goes in your favor, you will make money. You predict it is going to go this way, and if it goes to your favor, you also make money. But there are tools that will help you to do these predictions. You are not going to do it just like that. How does Forex trading work? Currency pairs developed naturally through the global market exchange, like banks, governments, multinational companies, financial institutions that trade these currency pairs every day, and the traders also that constantly exchange one currency over another. Then we have an organization called ISO, International Organization for Standardization. These are the people that created three-letter currency codes used worldwide under the ISO 4217 standard. That's why when you come to your chart, as I'm going to show you in this video, you will see EUR, that is euro, GBP, that is Great Britain pounds, JPY, that's Japanese yen. You see NGN, that's Nigerian naira, GHC, Ghanaian cedis, and stuff like that. The ISO created a three-letter currency codes. That's what we are using all over the world today. Now, what does this standard code does? It allow banks, brokers, trading platforms, and financial institutions around the world to identify currencies consistently. When you buy a pair, what you are simply saying or what you are speculating when you say you buy or you want to buy is that you are saying that that particular currency, last the first currency from the pair, the first currency is going to be stronger or is stronger than the other one. For instance, you have here Euro USD. Now, when you buy, you are literally saying that Euro is stronger than USD. That is what it means. When a currency rise, that currency becomes strong. So that's what the buy means. When you sell, you are stating that euro will be weaker than the USD. That means USD is going to be strong and the euro will be weak. So your profit depends on whether the market moves in your direction. That means if you place a buy, that means you are predicting euro to be strong. If market moves in that direction, that is when you make profit. And if market moves against you, that is when you make loss. Who is a broker? I mentioned it as a middleman that connects Forex traders electronically to the global market. So we want to look at what the broker is. A broker is simply a middleman. I want to use the word middleman for easy understanding between you, the trader, and the global Forex market. The broker provides you with the trading platform. That's the work of this broker. He's the one that will execute your buy or sell order when you give him the instruction to do so and give you access to the market. Now, see him as the bridge that connects you to the Forex market. Without a broker, you cannot trade Forex electronically. Now, there are a few things you need to look at when you want to choose a broker. The first one is regulation. That be sure that that particular broker you want to use is licensed and trustworthy. The number two thing is low spread. Now, when you want to place your trade, there is a little cost attached to it. So that is what we call spread. Be sure that the broker you are choosing is a broker with low spread. That's low cost of trade. Next is that the person, look out for a broker with fast withdrawals. That's quick access to your money. When you work, you are entitled to the fruit of your labor. So you don't need a broker that when you place a withdrawal to gain access to your money, it will take days before they will give you your money. Look for a broker with fast withdrawal. Next is that let that broker have a reliable customer support. When I mean customer support, responsive customer service. Sometimes issues might come. You need someone to talk to. Let it be that they have active customer service that will attend to your queries, your questions, and your issues to resolve it. Then let them have a good trading platform. Platform that is very easy for you to access and is also stable and the beginners friendly. I use Xness Broker. I will drop the link in the description. You must not use the broker I use, but Xness is reliable and they have fast withdrawal, supportive customer care. So if you need a good broker and you are within Africa and some of European countries, you can use Xness. I leave the link. That's the first link in the description. That's my Xness brokers link. Understanding currency pairs. A currency pair is the quotation of one currency against another. In Forex, we trade currency in pairs. That means in two. And this is because when you are buying one currency, you are selling another currency. For instance, If you have naira and you want to buy dollar, that means you are selling naira in order to get dollar. If you have euro and you want to buy dollar, that means you are selling euro in order to buy dollar. That's what we mean by currency pairs. Now look at this diagram. When we say currency in pairs, that means in twos. The first one you are seeing here, this we have here, Euro USD. So Euro is at the left hand and the USD is at the right hand. That Euro at the left hand is what we call base currency. And the USD at the right hand side is the one we call quote currency. When you say you are buying Euro, what it means is that you are saying that Euro being the base currency is going to rise. Or when you say buy, what you are buying is Euro. That is what it means. The amount you are seeing in USD is the quote currency. That is the currency used to measure the value of that Euro. That is what you are going to pay. Let's take for the instance, if Euro is 1.14500, it means that 1 euro worth $1.14 or $1.15 approximately. Like if you want to make it to 2 decimal places. So for you to buy euro, it is going to cost you $1.14. When we go over to the chart, you will see the price panel. When you are buying euro, you are paying this amount in the price panel in order to get 1 euro. How do we make money with this? Listen, no one will send you money simply because you click the buy or the sell button. No. Your profit or loss comes from the changes in the exchange rate. For example, let's go to this chart. If you buy euro at 1.14250 and the price rise to 1.14300 and you close the trade, you have gained 50 pips. Don't worry about pips. I will explain it later in this video. So keep watching. That 50 pips becomes your profit because that is the increase, the exchange rate increase. On the contrary, if you buy euro at that same 1.14250 and the price falls to 1.14200, that means the market moved downwards with 50 pips, and that's against your prediction. So you will have a loss of 50 pips, and whatever that is the monetary equivalent will be deducted from your account. When you gain the 50 pips, whatever that is the monetary equivalent will be added automatically to your account. Now, in buy, you are predicting that price will go up. And in sell, you are predicting that price will come down. Now, let's do this. In Forex trading, when you hear buy, long, bullish, the three words means the same thing. They are talking about buy or price rise or price increase. Buy, long, bullish. All of them are talking about price increase. Then when you hear sell, short, bearish, all of them are talking about price moving downwards. They mean the same thing in Forex. So when people tell you long, they are simply telling you buy. When they tell you bullish, they are simply telling you that price is moving to the upside. And when they say buy, that's a common language that we all know. The same thing when we say short, that means go short, that means sell. Bearish, that means market is moving downward. And the sell, we all are conversant with that particular word. Forex trading sessions. The Forex market is open 24 hours a day, 5 days in a week, from Monday to Friday, except on general public holidays. Now, this is because trading moves from one financial center to another around the world. We have 4 trading sessions, and they are Sydney, as you can see on this diagram. It opens 10 p.m. to 7 a.m. The Tokyo session opens 12 a.m. to 9 a.m. London 8 a.m. to 5 p.m. and the New York 1 p.m. to 10 p.m. These ones I mentioned now is what? Depending on your time zone. We have 3 major sessions. The Tokyo and the Sydney, they are combined to give us what we call Asian range. That Asian session is what starts the market for the day. It's very quiet, and that is where liquidity is being built up. Then they now hand over the market to the London session. The London session moves with volatility. That's when you see activities in the market. And the London session hands over the market to the New York session. There is high level of activity as well during the New York sessions. And the New York sessions hand over the market back to the Asian range. Now, this is just the circle every day, 5 days in a week. During the Asian range, the market is usually quiet. We have few pairs that moves like JPY, Japanese yen, that moves the Asian range, including the New Zealand dollar. During the New York and the London sessions, we also have pairs that move well, like Euro USD, GBP USD, USD, JPY. All of them moves both in London sessions and in the New York sessions. There is what we call overlapping, that period when London is still on and New York is opening. That overlapping period, there is always high level of volatility in the market. Time frame. A time frame in Forex trading is a selected period of time that show how the market moves. Now, each candlestick represents the price movement during that specific period. Now, Forex time frame is measured in seconds, as you can see in this chart. Minutes, hours, days, weeks, and even months. Depending on the type of traders you are, because we have about 4 types of traders. We have the scalpers, we have the day traders, we have the swing traders, and we have the position traders. So depending on the type of trader you are, that is what helps you to choose a time frame that is suitable for your own trading strategy. Lot size and its calculation. A lot size is the number of units of a currency or assets you buy or sell in a single trade. Now, it is what determines the size of your position and how much you stand to gain or lose as the price moves. I want you to look at it this way. Before we go to the chart, let me show you the calculation. A lot size is like the quantity of an item you buy in a store. That's just the simple explanation. The bigger the quantity, the bigger your potential profit, but also the bigger your potential loss. So you understand this, because that's where a lot of beginners get it wrong and they blow accounts. Your lot size tells the broker how large or how small your trade is. We have 4 lot sizes. the standard lot size, which is measured in 100,000 units, and the monetary equivalent is $10. The mini lot size, measured in 10,000 units, the monetary equivalent is $1. The micro lot size, measured in 1,000 units, and the monetary equivalent is 1 cent. And the nano lot size, not all brokers use this nano lot size, just a few brokers that use it. It is measured in 100 units, and the monetary equivalent is 0.01 cent. A lot size should always be chosen based on your account size, your stop loss distance, and the percentage of your account that you are willing to lose. Please take note of this. The percentage of that account size you are willing to risk. Pips and its calculation. A pip is the smallest unit of price movement in currency pairs. Traders use pips to measure how far the markets have moved in their favor or against them, and also to calculate their profit. If you have watched this video to this extent, congratulations to you. That means you are gaining value. Be kind enough to subscribe if you have not done so, and share this video so that other traders will see it. Give this video a thumbs up to enable YouTube algorithm to push it to a wider audience. And don't forget to drop your question in the comments. I will respond to it. Take profit TP and stop loss SL. Take profit and stop loss are one of the most important tools in trading that help you as a trader to exit the trade automatically, whether you are online or offline, when properly used. If you use them in your trading, once market gets to that level, if it is your take profit that it hits, it will close that trade automatically and your profit will be added into your account. And if it hits your stop loss, automatically the trade will close and the amount will be deducted from your account. The essence of stop loss is not that you will not lose trade. No. It is to help you reduce the amount you would have lost if you didn't use them. That's why it's very important to use your stop loss. If the trade goes against you, you wouldn't lose all. You will lose just a certain percentage. And that is where proper risk management comes in. And in case you are looking for one-on-one coaching, you can reach out to me through my Telegram group or through my WhatsApp group. The link is in the description. How to place your first trade. Let's get into the chart and I will show you how to place your first trade. If you've watched this video to this level, congratulations to you. This is the last part of this video, and this is how to place your first trade. This is Euro USD. That's the pair I've been using in my illustration, and I want to use it to show you one or two. Now, when you want to place a trade, you don't just look at your chart and decide what you want to do. No, that is not the right thing to do. You need to analyze this chart. I'm not going to do analysis, but I'll just show you how you can place a trade. I have a lot of videos in my YouTube channel. You can sit down, watch free videos. There's no way you watch my videos and you cannot start your trading journey. But if you can afford mentorship, please go for mentorship. I run one-on-one mentorship and group mentorship. You can join my academy. You can reach out to me for mentorship. Let's assume I want to take a trade. I piqued interest in this area. If you have any question, drop it in the comments. I will respond to your question. I'm not going to take these trades in the 4 hours time frame. I'm going to take it in the 15 minutes time frame. So I go to 15 minutes time frame. That's where I normally take my trade. I refine my point of interest. Now look at this particular one is called long position. We use this one when we want to buy. And this is called short position. We use this when we want to sell. Remember, we said sell, short, bearish, buy, long, bullish. So looking at this market, it is bullish in nature. This is where I have my last break of structure here. That is one of the things that is giving me the confidence to look for buy. This is a current trade, a current setup. If you come across this video when the setup has not played out, you can take advantage of it. But if you come across it when the setup has already played out, thank you for watching. All right, guys. I want to explain this, right, before we continue. I'm still seeing this place. This market also may react here, but let's finish this one first so that you don't get confused. I want to show you something. I trade price action and the SMC concept. That's what I am known for. Looking at this, you can see some figures up and down. Let me adjust this. You can see figures up and you can see figures down. Now, where you have your target, this is what you are likely going to get when this market hit your target profit. And what we have here is 94.2. This 94.2 simply means the pips that we talked about earlier on. So from this particular point to this level, what we have is 94 pips. And the amount, depending on the lot size, but they are giving you their own amount based on this particular long position is 2028 points this. But when we do our own calculation, as I'm going to take you to the real calculation, you will see that it depends on your lot size. It is the lot size that you use to trade or enter your market that will determine the amount that you are going to get. Hear me very well. The bigger your lot size, the bigger your profit and the bigger your losses. So use your lot size based on your account size, not based on what you want to make as profit, please. If you want to last long, or if you want to preserve your capital. Now, this is where you have your entry, this point, and this is your stop loss. What this simply means is that if this market goes against you, if price come down and it moves against you, once it gets to this level, you are telling them, broker, close this market at this point. I don't want to continue losing my money. Whatever be the loss, they will deduct it from your account once it gets to this point. Now, looking at this, we have 22.9. That is, you are risking the pips from your entry point to where you want to close it if the trade goes against you is 22.9 pips. Why the one that you are going to gain is 94.2 pips. Now let's look at this interesting part. This is called price panel. This is price panel. That is, once you put this long position or short position, they will give you the parameters that you're going to use to enter this trade. Now we have this one in ash color, 1.13851. Let me write it down to our calculation. 1.13851. That is our entry point. Then our stop loss is 1.13622, and our take profit is going to be 1.14793. If this market move in our direction, now this market, I said that it might react here when it gets to this level. Yes, I have other confluences that made me believe that the market might react here. This is another opportunity that you can take advantage of. But before then, let's place this one that we just calculated. Let's place the market. I had to pause this video at some point when I watched and noticed that my Xness wasn't captured in the video. So that's why I had to cut off that part and continue the recording again. You can see, as I said, that the market will react here. You can see that the market actually came to this level and they reacted a little bit above this level. And if you see, it pushed down again before moving. It may still return back to react at this level. It may also, depending on this one now has to do with fundamental news. Depending on the fundamental news that we are going to see this new month, because today now that I'm completing this part of this video is August 2. So as the new week opens, market is closed now. You can see there is no movement as we were seeing in the previous video. So market is closed now. Depending on what we are going to see this new month, maybe when it comes here, either a reverse market here or it will break this zone and return back to this level. I want to set alert at this level so that whenever the market is moving down and it gets to this level, it will signal me. I don't need to come and sit down every day in the chart and be looking at the chart waiting for the price to return to this place. No, I set alert, and once market price hit this level, it will signal me. Please, when you are, I will do a video and put here, watch out for that video, how to navigate this trading view. I'll put out the video here. When you are signing up for your trading view, I'll also drop a trading view, my trading view link in the description. Check for the link. You can use it to sign up with trading view. It's free of charge. Maybe when you continue in your trading journey, you can decide to subscribe because you need that subscription though. So when you want to set alert, you want to know the price or map out a particular price. Me, I put the price here. I put this yellow dotted line here so that I can use this price to set the alert. What it means is that whenever price gets to this level, it will signal me. When you are signing up for your trading view, use the same email that you used to sign up for your trading view in your PC, in your laptop, to also sign up in your phone. What it means is that if the alert, if price hits your alert, you get the signal not just on your PC, because it's not all the time that you'll be with your PC, but you also see the alert on your phone because you have the trading view on your phone. Secondly, put your phone number. If you want to be receiving it as a message, then put your phone number when you are signing up. So this is the alert. You click on the alert. It will show you this panel and put the value that you want. I want to put 1.139. 1.13968. That's the alert I want to put. 1.13968. Then the next thing I would do, you see this place they say crossing. I want price when price is moving to the downside, because where I am targeting is at the downside. Okay, so I'll click here and click cross down.
What it means is that if price is moving to the downside, once it hits here, it will signal me. If I am waiting for price to come to the upside, what I will do is to click crossing up. Okay. So, but now we are focusing on crossing down because that's where we are expecting price to get to. Then we now get informed. Then you click on create. It has created this alert. You can see it. Look at it. Just click once. If you click twice or 3 times, it will keep putting the alert. In case you mistakenly double click or click 3 times, just highlight on it and click this delete. It will delete the alert. Okay. Or you come here. You see the alert. I have alert on gold crossing up, as you can see at this price. So this is the current one I set. Okay, good. Now the next thing we are going to do is to calculate our risk. Please pay attention. This is where a lot of beginners get it wrong. If you don't know what you are risking, any little shift can blow your account. This is the account size. Now, this is what I am risking, 0.5%. I'm going to use 0.5. I'm going to risk 0.5 to place this trade. Any risk above between 0.5 to 2% of your account size per trade, you are gambling in that trade. You are gambling with your money. Limit your risk, please. Now, let me bring my calculator. Let's calculate and know what our stop loss is going to be. You need to know all these things. That's where the struggle and blowing of accounts comes in. We are going to do 0.5 divide by 100, which is 0.5%. We have 0.005. Then you now multiply it by the account size, which is 48,012, and it will give you $240. That means I am not going to risk more than these $240. Anything above these $240 is above my risk per trade. And if my stop loss is below this $40, that gives me an opportunity to place another trade. If you have question, drop it in the comment. I will respond to it. Let's place the order now. This is the XNES interface. So our main focus is here. We want to know what we are doing exactly. At this point, we've gotten our coordinates and the parameters. So we want to place the order. This is where you place your order. The item we are using, or the currency we are using, is Euro USD. When you open your own, you will not have all of these things up here. So you just search for the instrument that you want to trade and add it. We are using Euro USD. So I click on Euro USD because I already have it at my favorite. What we want to place is a buy limit order. I'm not going to place market order because price has not gotten to my area of interest. So I'm going to click buy, and depending, what we are placing is buy limit order. Is then whenever the price gets to that level, that's when they will activate that market. If I want the market to start immediately, that means price must have gotten to where I want to place the order. I can now go with market order. Now the first thing here is my open price. I'm going to put the open price, which is the number or the figure, which is the figure in the ash color where we have 1 point. 138.51. Then we go to volume. Volume is where you put your lot size. I'm going to use 0.5 for this trade. Pay attention, please. If your account size, you are using personal accounts and the account size is from $500 down, reduce your lot size. Reduce your lot size. Don't use lot size based on the amount of profit you want to make. If you do that, you will not last in the industry. The account will not last for you. Manage your risk properly. I started by showing you how much I risk per account. You can see the size of the account and my limit, my risk limit. Now I'm using 0.5 to place this trade. This is what I'm expecting to gain if price go in my direction and hit my take profit. And my take profit is 1.14793. If price hits my take profit, I'm going to gain $471. It will give me 94 pips, 94.2 pips. Then this is my stop loss. My stop loss is 1.13622, which will give me $114 if price move against me and hit the SL. The total pips for my stop loss is 22.9 pips. That's the difference from my entry point to where I want them to stop this trade in case the price move against me. While if I am gaining, I will gain 92 pips if price goes in my favor. The risk to reward in this trade is 1:4 risk to reward. For every $114 I risk here, I am going to gain $471. That's what this means. And it's actually a good trade. You can see that what I am expected to risk or what I'm proposing to risk in my trade is $240 maximum. But if you look at this trade, I have $114 already. So I can go ahead and click confirm and the trade will place. It has pending order place. You can see it here. So I have placed that order. Once market gets to that level, whether I am around or not, they will execute the order. Having that $240 as what I propose to risk, and my stop loss in this particular trade is $114. What it simply means is that I still have the space to place another trade. I can take another instrument, but I must make sure that my risk did not exceed $240. Even if I'm placing 10 trades, 20 trades and all, the risk will not exceed $240. That's what we call proper risk management.
Remember, becoming consistently profitable doesn't happen overnight. It takes practice, patience, discipline, and proper risk management to scale through.